Hello everyone, how's everyone doing today? Alright, so let me get this music down. Alright, welcome everyone to Sesky Trades once more. Yeah, we're here again today. Continuation from where we stopped yesterday. Today we have a different topic entirely. We have a different topic entirely. So, before we get into that, excuse me, before we get into that, I want you guys to look at the charts. I remember I was doing this as a sample trade. I did a sample, just a very quick analysis, and brought out my tool and sorry about that. All right, so like I said, as I was saying, yesterday we did sample analysis. We talked about futures trading yesterday. It was amazing. Though we had a little technical issues here and there, but I pray today is gonna be better. I've tried to make sure that things are better today. You can see from our little simple analysis we did yesterday, after picking out my shells position tool, you can see that if I had taken this trade actually, because I didn't take the trade, I was just using it to analyze for you guys. If I had taken this trade, see it's already going in our position. All right, this is where we're around somewhere here yesterday, and I did my analysis and said that price is going to retrace and come back to mitigate an order block. You understand? So it mitigated my order block here. You understand? So I brought out my rectangle to mark it, marked my order block, and see it came back and mitigated this particular region. It touched, it entered a little bit, went up a little bit, and boom, started coming down. So this is a confirmation that okay, we are going to a downtrend is starting. You guess after it had changed character, it broke through the previous higher low. All right. So you can see that now price is going downwards. All right. So if it hits here, then I'll be in good profits. You understand? That's if I had taken it. But I didn't take it. I was just using it for analysis. But as you can see, with just a little analysis, price is has is going my direction. And I wish I'd taken this trade. I wish I'd taken this trade. I wish I'd taken this trade, and we'll be in stupid profits. We'll be in stupid profits. So that is just how futures trading is. And if you do your analysis properly, apply proper risk management, you're going to make money in this. You're going to make money. And like I said yesterday, the right platform to, my platform, the platform I use is LBank, and this is LBank. We use to analyze this, and we can see how the trade is already going. You can see how the trade is already going. All right, all right, all right, all right, all right. Let's get to what we have for today. Let's get to what we have for today. We'll come back to this. We'll come back to this. So let's get to what we have for today. All right. So today is basically we're talking about risk management. So I want to welcome everyone once more. Welcome everyone once more. This is Sesky Trades. This is Sesky Trades. I'm Sesky. I'm Sesky, and I'm here to talk to you guys about risk management. Risk management is the most important thing in trading. Risk management is the most important thing in trading. So before we open the charts, before we start talking strategy, and before we start talking entries and all that, if I start teaching you all those various strategies and all, we need to know this properly. We need to do something. We need to set this straight and we need to know about risk management. All right. Okay. Moving on. All right. You can see from. Let me get my pen out so that I can explain some things. All right. So I hope it's still big enough for everyone to see. All right. So today is not about. It's not a hype session. Today is not about profits. Today is basically about survival. Today is about survival. Today is about survival. All right. Today is about survival. So as you can see from what we have here, today is not about profits. Today is about survival. Most traders don't fail because they are stupid. All right. They fail because nobody taught them how to protect themselves. So today we are going to fix that. So most traders, most times you hear people say, "Oh, more I liquidated my account. I'm not trading." Um, I want some people that want their accounts and they go for revenge trading. That's very wrong. Lots of things happen in the trading cycle, in the trading world. Most people, if you're not smart, if you not follow proper risk management methods, you will lose. The market is not your friend. It's not your father that owns the market. It's not as your mother. Market is not your friend. So you have to use proper risk management methods that work. All right. So uh, this if there's one thing you should be, take very, very important since we started this trading this live sessions is this risk management. Take it very, very seriously because this is going to basically know- tell you if you're going to survive or show if you're going to survive in the markets or not. All right. If this sounds familiar, this session is for you. Have you ever gone all in on one trade before? I have. I'm guilty of that. I'm super guilty of that. I've gone in that. That was when I was starting out, when I was still a beginner. I went with all in on a trade and thinking the trade was gonna go my way, and it started going my way. Then suddenly, boom, the market did its thing. All right, I was still a newbie then. I was still just getting to know how to trade futures, and this happened to me not so long ago, mind you, because futures trading is still I'm still learning futures trading, even though I just started. I started earlier than you guys that are teaching. I might even know more than me. But we learn every day. We learn every day. We learn every day. All right. So have you ever removed stop loss because you felt too confident? I'm also guilty of this. I did that. I really did that also recently. I felt too confident and I removed stop loss because that's the thing. Yeah, the human factor always sets in. So you need to remove emotions when you're trading. When you're trading, the market doesn't send your emotions. You know, send your papa. Do you understand? You know, send your papa. The market is not your friend. So I removed stop loss because I was too confident and I wasn't using isolated margin. Or it almost cleared my account. I had to, and I wasn't. I, I didn't even want to go to the details of that. I nearly ran my, but that was the mistake I will never make again. All right. So everyone is human, make mistakes, but learn from our mistakes. Learn from which traders that have been there, done that. Learn from mistakes so you don't make those mistakes yourselves. Okay. Have you ever said, let me just recover this one loss? This is another thing, revenge trading. You want to recover a loss because you made a loss and boom, you want to enter back into the market and try and recover that loss. The market will mess you up. It will mess you up big time. It will mess you up big time. I'm also guilty of this. I did this a while back. It was crazy. It was it was crazy. It was crazy. It was crazy. I've done this in the past when I was just started, and sometimes it might work to your favor, but I'm not sure you 70% of the time it wouldn't work to your favor. Okay, so next, now the real reason traders fail. Traders do not lose because they are always wrong. No, they don't lose because they are always wrong. They lose because they are too wrong once. Oh my God. The market forgives mistake, it does not forgive recklessness. Do you understand that? Traders do not lose because they are always wrong. They lose because they are too wrong once. The market forgives mistakes, it does not forgive recklessness. I need you to read that, let that get in and assimilate that. All right? All right, so as I was saying, traders do not lose because they are always wrong. They lose because they are two wrong ones. The market forgives you, say, but it does not forgive recklessness. I'm going to give you guys one sentence today. Your job as a trader is not to make money, survive. Okay? Your job as a trader is not to make money, but to survive. I'll say this a lot of times today so that it gets stuck into your brains. Your job as a trader is not to make money, but to survive. All right? So the trader is not to make money, but your job is to survive. You can be wrong 10 times. Sorry, guys. Just trying to set up something in just a minute. All right, so that's what I was saying. You can be wrong 10 times with small losses and still survive, basically, but you cannot be wrong once with an oversized risk and survive it. That's just it. All right. So that's where risk management comes in. Okay, that is where risk management comes in. Your job is to survive. All right, it's not to make profits. I'll say that again. Your job as a trader is to survive, and it's not to make profits. All right, even though you get profits is the goal, but if you think like, okay, I want to survive. I want to survive. How do I survive this market? That is when you now make the profits. That is how it works basically. All right, how do I survive the market? All right, think survival, not profits. Think survival, not profits. If you think survival, the profits comes in, the money comes in. That's just the way it works. Okay, that's just the way it works. All right, see it's written here in bold for you. Your job as a trader is not to make money, it's to survive. I'll say it again. I'll repeat it again. I said I will say this, I might say this 100 times today before the end of the stream. Your job as a trader is not to make money, it's to survive. All right? Do you understand that? Oh, now here is this myth. A high win rate makes you a good trader. All right? You can have a 70% win rate and still, excuse me, you can have a 70% win rate and still blow your account. One oversized loss wipes out weeks of discipline. So that is why you have to be disciplined. Be a very disciplined trader. All right. You can be having 70% win rates on all your trades. Okay, now see the one I did yesterday, this one I did. That's percentage of that's the win rate. Okay, that's part of a win rate. I might have that kind of trade maybe 7 out of 10 times. Okay, I have that kind of trade 7 out of 10 times. Then if I now make one mistake and do an oversized and get an oversized loss or more, weeks of discipline is already off. It's already thrown to the wind. It's already gone. All right. So it's just crazy that many people like this that there's a saying that is it 90 to 95% of traders are not are not profitable. I don't know how I don't know how true that adage is, but looking at traders everywhere and traders that have lost money, that metric might be true. All right, that 90 to 95% of traders are not successful. It's only about 5% of traders that are successful. And the 5% of traders that are successful are the disciplined ones, the ones that use proper risk management, the ones that remove emotions out of their trades. So throw away emotions, keep emotions away, and you'll be very, very successful. Win rates without risk control is just delayed failure. Do you see that? Win rates without risk control is just delayed failure. See, wins. Just one mistake, one oversized loss cleared all this on the graph. It cleared this whole win rate. So you have to be smart. You have to use proper risk management strategy. Right. The unforgiving matter of a big loss. Big losses don't just hurt. They change the math against you. Can you see that big losses don't just hurt? They change the math against you. Big losses don't just hurt. They change the math against you. All right. Think in percentages, not dollars. All right. Amateurs think in money. Amateurs think in money. Oh, I lost $200. That's very, very emotional. Professionals think in percentages. I lost 1%. I lost 1% of my portfolio. Oh, I lost 1% of my margin. I lost 1% of my whole futures wallet balance. That's very logical. But when you come here, you're very, very emotional. Amateurs think in money. Professionals think in percentages. All right? Amateurs think in money. Professionals think in percentages. All right, let's start simple maths here. All right. Um, I'm back here so that we can see this. If you lose 50% of your account, you need 100% just to break even. Okay? If you lose 50% of your account, you need 100% to break even. Do you understand that? What is break even? Hmm? When I ask, when they say what is break even, that's something you need to understand in trading. If you lose 50% of your account, you need 100% to break even. Just to break even, you have not even got into profit. Okay? So for instance, you have $10 in your account. But let me use $100 as an analogy. Okay. You went you entered a trade and the trade went against you and you lost 50% of that $100, which is $50. All right? Which is $50. Okay. So now you now want to break even. This is simple English. All right. So you now enter another trade, hoping that the trade goes your way, and the trade gives you profit, and you get a 50% profit. So that 50% profit now just recovered your former 50% loss that you made. So you are now even. Then to make more profit, you need another 50%, which is the 100% we're talking about. All right. So you need 100, at least 100% to break even. Gain required to break it, total even. You understand? I don't know if the way I explained it in layman's terms is understandable to you. All right. So that's just what it is when we are talking about breaking even. So you need to trade. Don't be play. Oh. If you lose 80% of your account, some people might not recover. The people will just get off the market. You understand? So you have to be very, very smart. You have to be very, very smart and take some risk management strategies that we'll talk about. Okay? We've already spoken about being emotional and logical. Anybody that says that I lost $200 is emotional, and that's a fact. It pays you more as a guy man. You enter market and you lose $200, maybe the trade went against you and you lost about that amount. About that amount, that the emotions is getting to you. It's paining you that you lost that amount. That means you must have disregarded some risk management strategies or methods that you needed to put in your trades, but before you enter your trades. All right. But when the professional says I lost 1%, I lost 2%, that means okay, the person has been very, very logical. The person must have done his calculations right, and he knows that okay, this is just the amount he's losing. He's not putting in emotions. You understand? That's a very professional way to put it. I lost 1% of my account. I lost 2% of my account. I lost 10% of my account. I lost 20%. You understand? So that's just the way it is. That's just the way it is. That's just the way it is. So moving on. Big losses don't hurt, so they change the math against you. All right, let's go on. The one rule that guarantees survival in trading, the one rule that guarantees survival in trading is to risk 1 or 2% per trade. That is no single trade. That's it. No single trade deserves your account. You understand? One rule that guarantees survival is risk 1 to 2% per trade. That's why you need to fund your accounts large money. But as most beginners, especially here in Africa, down here in Nigeria, as most beginners, because they usually start with very, very small amounts, they tend to want to just put everything in. You will blow your accounts. You understand? You will blow your account. See the example that is put there. Example, $1,000, 1% risk of $1,000 is just $10. You have $1,000 in your funding in your futures wallet. You have $1,000 in your futures wallet. And any trade you want to go to, what you risk is 1%. Now 1% of $1,000 is 10%. Sorry, it's $10. So if the trade goes as against you and you lose that trade, you're losing $10. You will survive the market. Because if you're a good trader, if you're a good trader and you probably make 70% of your total, you know, trades, you win 70% of your total trades. This is definitely going to work for you. Okay? This is definitely going to work for you. You will definitely survive the market with that. You will definitely survive the market with that. So do not risk more than 2% of your account. Like here they said 1%. So 2% is $20. So let's use the Nigerian analogy. I know most of our dollars here in Nigeria, most of our dollars here in Nigeria say that you can use 5 to 10%. So and they can't lose more than they can't lose more than 30% of their trades and all that. Yeah, it works, but it's very risky. That is why most of them say, okay, start with $100 or more in your account. Fund your account with $100 or more. Fund your account with $100 or more. And it's it works sometimes, but the worldwide standard, the worldwide professional standard is that you do not risk more than 2% of your trade. I know maybe my last video I said 5 to 10%, which is still is very risky, but different what's that adage again? Different this thing for different falls. Okay. All right, so the standard is not risk more than 2%. But sometimes me myself, this is me being straightforward with you guys. I myself, I usually go trading with at least 5%. You understand? Or at most 5%. That's what I meant to say. At most 5%. All right. So, but some of them say 5 to 10%. Because maybe your funds are small. You're starting with $100, you putting $10 in the market. After you must have done proper analysis to be sure that the trade will go your way. Yeah, I'm very sure you had the trade to go your way. But the standard is do not risk more than 2% of your thing. But mostly here in Africa, here in Nigeria, because of the entire market of small funds and they want to make quick profits. They want to make so they say 5 to 10%. But I advise you if you have good funds, do not risk more than 5%. That is mine. That is how I do mine. I go with 5%. I go with 5%. I go with 5%. And it has worked out well for me. It has worked out well for me. So you need to. That's why you need to do your homework. That's why you need to do your homework and then proper learn proper technical analysis so that when you do your analysis, your trades, you're sure that okay, you cannot be 100% sure, but at least try and win 70 out of the 100% of your trades. 70% of them try and win, or 60% of trades, and you'll be fine. You'll be totally fine. You'll be totally fine. So try. So make sure you analyze. That's why you need to learn technical analysis properly, so that once you start trading, once you make a few losses, you know that okay, maybe your next trade is gonna be a profit. The next two trades will be a profit. The next two trades will be a profit. And that is why I love this trading strategy, which we're still going to talk about soon, the smart money concept, because the leverage of the your return, your ROI in SMC is usually very, very high. Usually very, very high. Your risk to reward, you get a very high risk to reward ratio in SMC a lot of the times. Check out this other, that it was an SMC strategy I used to trade this one, this one that is already going my way. You can see. This is a trade I did just I analyzed yesterday. You can see, this was the, this was, it was the other block. Market came back and retested this region and started going back down. Started going back down. Sellers had more strength. Sellers took over the market and started pushing the price downwards. They're pushing the price downwards. And here we are. Here we are. So there's a reason you can take partial profits. That way you guys are doing that. Take partial profits. All right. Started going down, and here we are. I pray it hits. I'll watch this trade and see if it's gonna hit. Take profits. This is where we start. Okay. Normally, I'm even supposed to stop. Okay, yeah. It was close to. But let's just see. Let's just watch it. So let's get back to. So for this example, like we said, the $1,000, 1% risk is $10 per trade, every trade. So no matter how confident you feel, that trade is only allowed to lose $10. That trade is only allowed to lose. See, discipline is very important in trading. Like I said, don't trade with emotion. This has to do with discipline. Discipline is super, super, super important in trading. Discipline is super important in trading. All right. So never allow this to, never. You need to be very, you need to be a very, very disciplined person in your trading. If if you come out with your trading, you need to set trading rules for yourself. Understand? Set trading rules for yourself. If you come up and say, okay, I want to risk just 2% of my account for every trade, you have to stick to it. Stick by it. Don't change it. Don't change it. Stick to it. Okay? Do not change it whatsoever. Do not change it whatsoever. Stick to it. That's discipline. Don't change it. You say, okay, I'm not spending more than this amount. Or maybe, okay, today my trading rules, okay, maybe you create trading rules for yourself. Say in a day, I wouldn't do more than 3 or 4 trades. Stick to that. That's discipline. You need to be very, very disciplined in all this. Super, super disciplined. All right. Super, super disciplined. So let's move on. Just a minute. Don't know why. Can you guys still hear me? Yeah, obviously, yes, you can. Remember, your job as a trader is not to make money. Your job is to survive. I'm saying that again so that you guys remember. Your job as a trader is not to make money. Your job as a trader is to survive. Your job as a trader is not to make money. Yeah, look at me. I'm talking to you. Yes, you. Your trader is not to make money, but your job is to survive. Okay? Say it with me again. Your job as a trader is not to make money, but your job is to survive. Say it in your head. Your job as a trader is not to make money, but your job is to survive. All right? All right. I just wanted you guys to just sit down and assimilate that. All right, so let's move on. Small risks basically does something very powerful. It does something super powerful because small risk, I repeat again, does something very, very powerful. Let that sink in. Because when you take small risk, it gives you permission to be wrong. Small risk gives you permission to be wrong. I'll take that again. Small risks give you permission to be wrong. When the risk is small, the fear is small. And when the fear is small, decisions are better. When the fear is small, decisions are better. Risk management buys you time and buys you skill. Time buys you skill, basically. Risk management buys you time and time buys you skill. So that is why you need to risk small. When you risk small, your fear is small. When your fear is small, you make better decisions. And once you start making better decisions, you can see that risk management basically buys you time, and that time buys you skill. So the more you get into the market, the smarter you become about knowing what to do and how to enter trades. That's just it. That is just it. Risk management buys you time, and time buys you skill. Okay, that's just it. I want you to just relax and let that sink in. Small risk gives you permission to be wrong. Okay, gives you permission to be wrong. Let that sink in. Let that sink in. When you risk small, the fear is small. And when the fear is small, the decisions are better. Risk management buys you time, and time buys you skill. I'll pause for a moment. Let that sink in. Okay? While I pause, let me get listen to the music, the background music, and let me just get you. Uh, let me rehydrate. I need water. I forgot to put water close by, so I'm kind of thirsty so that I can continue talking. I replenish my strength for you guys. We're here. We're going to be here for at least 2 hours doing this almost every other day. So let me just get some water. I'm coming. All right, so let's move on. All right, guys. So now let's talk about position sizing in risk management and trading and all. So let's talk about position sizing. In trading, what people most people get wrong, you do not choose your position sizing first. You choose fit. You do not choose your position sizing first. You choose your stop loss first. See from our illustrated um, diagram here, you are choosing your position size wrong. You do not choose your position size first. The first thing you do, define your stop loss. Define where your trade idea is wrong. All right. Decide where your trade idea is wrong. Define your stop loss. Decide where your trade idea is wrong. Then calculate the maximum risk. Apply the 1 to 2% rule that we spoke about. You understand? So if you're going in with if you have a $1,000 in your futures wallet balance, we're going in with say 2%, 2%. Okay, well let's say 1% is 1% here is $10. All right, 2% is $20. All right, so no matter what happens, you still be able to get back to the market. You still have a lot of chances more to go back into the market. All right, you see a whole lot of chances more to go into the market. So if we order, then know where your idea is wrong, decide where your trader is. Just basically find where your stop loss is. Look for your stop loss. Then now calculate your 1 to 2% of your balance. If it's $100 you have, you know that 1 to 2% is $2, $1. You understand? Then calculate your position size. Your position size is the output of these first two steps. All right, your position size is the output of these first two steps. All right, so you calculate your position size is the output of the first two steps. All right, the stop loss decides the size, not your confidence. Do you get that? It's your stop loss that decides your size, not your confidence. Mhm. Stop loss decides your size, not your confidence. All right, the blueprint in action. So, a live calculation. All right, so let's do this together, step by step. All right, step one. Step one, account variables. Your account size. For instance, your account size is $1,000. Your risk per trade. We have decided, okay, you should choose 1 to 2%. So for this instance now, we are going in with 1%. So risk in dollars is $10. That's 1% of $1,000 is down $10. This is your maximum allowed loss. Take note. This is your maximum allowed loss. This is your maximum allowed loss. Okay. All right. Step two, trade values. So your entry price now. You decided on an entry price. For instance, the entry price of whatever asset you want to be trading. Sorry, I'm trying to. The entry price of whatever asset you're trying to trade is $50. Then your stop loss price is 49. $0.50. So you must have already targeted your stop loss. Always find your stop loss. All right, let me even show you something. In that trade that I did yesterday, see this is our stop loss. Okay, see where the entry price is. This is the entry price. So from down to here, this is stop loss range. Look at it. Let me see how I can make this so it's clear. Hold on, guys. Let me just see. I think having a little. Let me be sure we are still on. All right, so let's see. I just confirmed. Net network here could get messy sometimes. I could just be disconnected without knowing, but it's fine. I'll get a better network to use soon. All right. So I was showing you what was going on here. All right, you can see our stop loss. This is where our stop loss is, slightly above this. So from here to here is our stop loss. This is the stop loss. See the figure. All right, 94 in red is the one in red. Is the red box. That's your stop loss. All right, it's the red box. That's your stop loss. Then this is our take profits. All right. So our risk to reward ratio here was 2.21. You understand? 2.21. Let me even show you guys something. Okay, I'll get there. We're getting there. We're getting there. Our risk to reward ratio is 2.21. So if you're risking $10, if it goes against you, you lose that $10. But if you hit take profit, you're making two times that dollars. You understand? Two times that $10 that you risk. All right. You're making around $20. Sorry. Yeah. No, no, no. If you lose $10 for if it was the one to one, you make $10 profit. You understand? Then for a risk A 1 to 2, you make $20 profit on top of that $10 that you risk. So that's just the basic calculation. Let's just go back. All right, so as I say, entry price $50, stop loss price $49.50, risk per sharing is 0. That's the difference between entry and stop. Okay, that's the difference between the entry price, which is $50, and the stop loss price, which is $49.50. So the risk per share unit is 50 cents. 50 cents. So step three, the calculation, position size. Your position size, what you now put in as your position size, is risk in dollars, which is $10, which is $10, which is $10 divided by 0.50. You understand? So this is now your position size 20. This is what you put in that. I'll show you where you put your position size. All right, this is now your position size 20. This is a simple calculation. There are various other types of calculation that you can use to calculate your risk. All right, there are various other calculations, but this is one that is quite all right, simple and easy to go around with. Okay, so let's move to the next thing. The anatomy of a balloon account. The stop loss basically decides your position size, not your confidence. All right, no go do anything go end you. No go do anything go end you. They hear me so make I speak pidgin for now. Let me just go back there so that you guys can really see the calculation. Maybe I give you a few moments to write it down. If you want to write it down, if you with your books there, write it down. Or if you want to screenshot this, you can screenshot it. So make sure you put it down so you know this formula. I'll give you there are other formulas that we use to calculate position size. These ones are more technical, but we'll get there gradually. We're getting there gradually. Okay, guys, I think we're good to go. Let's move on. We're almost at the end of this class. The anatomy of a blown account. Basically, I just want to show you what blows accounts. Using fixed lot sizes on every trade. Okay, that blows accounts. Oversizing after a big win. It's basically called euphoria. You're so happy that okay, I got this big win. Then it's gonna repeat itself without oversizing the next trade. Boom, your account is gone. You so blow your account. It so blow your account. You oversize after a big win. And you feel so confident. Your account is gone. All right. Revenge trading to recover a loss. That's when you are this desperate. Revenge trading. I've been on this table before. I've been on this table, and it happens to almost everyone. Even recently, so you make a loss and you want to revenge trade. Yeah, you get so angry. Your emotions come in. You get so angry that this and boom, you want to get back into the market and try and make your profits quickly. Maybe because of it, just a slight mistake, the trade made against you, and you feel that oh, you can just get back in and recover. But you just blow your account. You will so blow your account. You will so like I said, the market is not your friend. It's not your papa getting market. Yeah, it's not your father that owns the market. It's not your friend. All right. So don't revenge trade. Do not revenge trade. Just let it go. Stick to the discipline plan. All right. Stick to the discipline plan. Stick to the discipline plan. Okay. Oversize, like, and remember oversizing after a big win, like I said before. Don't oversize. All right. Then setting position size based on the profit target instead of a stop loss. You're setting your position size based on the profit target instead of stop loss. That's so wrong now. Oh, wrong now. Come on. That's so wrong. You shouldn't do that. You shouldn't do that. You shouldn't do that. Okay. So this house blues account, basically. These few things I've just shown you, they blow account in such a way that I don't even know what to say, but I don't know what to say. But you guys should just take note of this. Take note of this and make sure you don't make the same mistakes. All right. This is very important. This formula, I'm coming back to this formula again. Take note of this formula. It's a very easy formula to calculate your position size. Though we'll do a live one here so that to show you guys how to calculate this particular position size. All right. All right. So make sure you put this formula down. Risk in dollars divided by risk per share. And your risk per share is basically the difference. All right. The difference between your entry and your stop. Okay. That one's where is my jotter? Just a minute. I have to jot some things down. So we'll get there. That one is more complicated than this one. But I'm coming back here because this is very important. And you guys need to do this. Okay. All right. All right, so both traders can lose. Only one survives. The gambler. This is what the gambler basically does. Hey, because you are not different from those people that do this Nigeria. You're not different from them at all. This is what a gambler basically does. No clear stop loss, oversized position, no clear stop loss. Let me take it slowly. Let me take it very slowly so that we go through. No clear stop loss, oversized position, hope based hope based trade. All right. You not put your stop loss in a trade. You oversize your position, the position that you're going in into the trade with. Yeah, you're trading based on hope. Come on now. Come on. It's wrong now. As how now? Apa, that makes sense now. That makes sense. All right. So, and the professional, see the professional's entry. You can see the line. This is the entry in the trade. You can see the graphs. Okay. This is stop loss down here. This is stop loss down here. This is stop loss. So, if for instance he had come in at this point and predicted that okay, maybe set a limit order that okay, when price gets to this particular spot, it should trigger. You see, it will not enter. It should not. This thing will not be triggered. It's not enter. Then maybe the price started going. Immediately it triggered. Boom, started going against him and hit his stop loss. The amount is just 1% of his account that he lost. Here. Yes, and it's just 1%. He hit his stop loss, and maybe the price now started going back up to make a little profit. But by that time, it has already hit his stop loss. So, but he wouldn't bother that much because how much is he risk? How much did he lose? He just lost 1% of his total balance. The confidence you are with now, you'll be so confident. Uh-uh, you'll be chilling. You'll be chilling. So that's just what it is. That's just what it is. Predefined stop loss, calculated risk. This is a professional calculated risk 1%. Calm, systematic execution. Calm and systematic execution. Okay, let's move on. I'm back here again. Your job as a trader is not to make money, it's to survive. Once you figure out how to survive in the market, then the profits will start coming in. Your job as a trader is not to make money, it's to survive. Once you figure out how to survive, then the profits will start coming in. That's just the way it is. Your job as a trader is not to make money, it's to survive. Once you survive, then your profits will start coming in. Let that sink in. In fact, I'll leave this here for a while before I go to the last thing we talk about before we now enter the chart. And I show you how to calculate your position size and with the same technique that we used previously. All right, just watch, read that for the next 2 to 3 minutes. All right, so I believe you guys have really assimilated that. Discipline, basically, like I've just been saying, discipline is your reward. The market does not reward bravery, it rewards discipline. That's just it. The market doesn't reward bravery, it rewards discipline. If you survive long enough, skill catches up. If you, all right, if you survive long enough, skill catches up. If you don't, nothing else matters. Discipline is, I'll repeat it again. Discipline is your reward. The market does not reward bravery, it rewards discipline. Discipline is your reward. The market does not reward the bravery, it rewards discipline. All right. If you survive long enough, skill catches up. If you don't, nothing else matters. If you don't, nothing else matters. Okay. So let's go on. And that's the end of the class. So we'll now go on our live trade and I'll show you a few things. All right. So before I do this, let's do another calculation. Okay. So that you guys get to understand that calculation of your position sizing properly. And let's use real assets now. All right, so I had already dropped an example here. All right, this is a signal. I'm sure some of you have heard signals before. So this is a signal. All right, so it says limit order, short sale, APT USDT, entry price 1.7716, take profit 1.548, and stop loss, that's what I said. TP means take profit 1. And SL is 1.746. Okay, so let's do it. Then what you see here is the stop loss percentage. Stop loss percentage that will be explained, but on TradingView you can even see it here. I can show you what the stop loss percentage is. Uh, let's go to TradingView first. Let me see. Uh-oh. Uh-oh. Right. I don't know if we're still on. Let me see, check, let me confirm. I don't know. Let me just see. Am I still live? Yeah. All right, I think we're still on. I just had to sort out some little technical issues I was facing here. So I believe everyone can still hear me and see me. All right, so instead of going to your trading view, let's just use LBank for the analysis, the small analysis and calculation I wanted to do. So we're talking about APT USDT. Let's get back to it. A limit order. This is an old one. It was just, let's just say it's fictional. It has already the entry price had already been met, and the trade had already closed. So, but we're just going to use it as an example, tentative example. All right. So, let's get back to it. APT USD, yeah, like I told you guys yesterday, we'll come here and search for whatever pairs we're looking for. APT. So let it search. Okay. So we're on the graph of APT USDT. So now, what was our entry price? We'll do calculation. We'll do a little math. I'm sure everyone can see this. So let's calculate the position size now. So let's do it together. All right. From the formula, let me go back to the formula. Hmm. All right. So what's my total account size here? The formula is account size. I'll come here and write it out. Ignore this one down. We'll get to that one. That one is a market order. Let's just go down. All right. So let's get back up here. So my account size, let me use capital letters. Account size equals $10,000. All right. So what next? We're looking for the parameters. Now the formula says before I even start writing those parameters, I'm supposed to have written out its position size is equals to risk in dollars minus risk divided by risk per share. That's your position size. All right, so let's get back there. Let's probably come here. Position position size equals risk divided by risk per share. So I needed to include risk in dollars divided by risk per share. So now, what is our risk? We say that we should not risk more than 2% of our account. All right. So 2%, we are going to use 2% because we use 1% because 1% of $10,000 is $100. So 2% of $10,000, if you do your math, is $200. All right. 10% of $10,000 is $1,000. So 2% of $10,000 is equals to $200. So we come down, right? Our risk in dollars 2% of $10,000. 2% of $10,000. So our risk in dollars is now equals to our risk in dollars is now equals to 2% of $10,000 is $200. So everybody knows how we arrived at $200. Okay. All right. So what's the next thing? The formula is risk in dollars over risk per share. And on the risk per share, we see what do we say the risk per share is? Is the entry price minus the stop loss price, right? Is the entry price minus the stop loss price. So we go and calculate that. Now we want risk per share equals entry minus stop loss. And what is our entry? What is our entry? Our entry is 1.716. 1.716 minus, I need to give some space here. So it looks neat. I'm sure everybody can see this. It's visible to everyone. Minus what is stop loss? 1.746. Uh, this is for, sorry, I forgot to say, we are going short this time around. We are going short this time around. So it will be the stop loss, that's the SL minus the entry, not entry minus the stop loss. When it's a long, it's the entry minus stop loss. All right, so don't mix that up. I forgot to say that. I should have pointed that out. So since we are going short, this trade is a short sell. The short sell, so you understand. If you are going long, it should be entry minus stop loss. But since we are going short, it should be stop loss minus entry. So let me quickly do that correction. So I totally missed that. So to be 1.74 1.746 minus 1 point, the entry price is 1.716, which now results to, let's see, 1.716 minus 1.746. So let's do that quick calculation. So 1.746 minus 1.716 is 0.03. So our result here is 0.03. So next, we now calculate the position size. Position size is risk in dollar divided by risk per share. So we've gotten our risk per share as 0.02. Our risk in dollar is $200. So position size, position size now equals to 200 divided by 0.03. What would that be? What would that be? What would that be? Let's go get that answer. So our answer is $6,666, $0.6, $0.66. So that is our position size. 6,666.67. Let's just summarize it to that. So now how do we use this? Now that we've gotten our position size, we now go to our interface. Sorry. All right, so we come here. Once we get to the interface, this is using a system. I'll do a video on how we can do futures trading on phone. The interface is very smooth, sticky, and sweet on the phone too. But me using a system here, this is what it looks like. All right, so I'm going with cross margin. I already showed you guys the difference between a cross margin and isolated margin yesterday. All right, our leverage it says 75x there, but we're not using any leverages. Just leave the leverage and we're trying to calculate our risk here. But I said for beginners, don't use more than 10x. All right, so entry price for the limit order. Right now we're at 1 point. You can see this is just 10. Like I said, this is just for testing, just to show you guys how you can enter with your position size. Okay, one. Excuse me. We choose cross, and we make sure that it's on limit order. Market order is when you want to enter the market immediately. You make sure that it's on the limit order, and this is market order, so it's already on limit. So what is the entry price? 1.716, 1.716. Now the cost value, this is where we are going to now impute the cost value. This is where we are going to impute the six, our calculation here. So where is it? 666.67. 6,000. Then me, I prefer using the advanced. Always come when you want to use your take profit and stop loss. That's what this means. TPSL. You always come here. I prefer using the advanced so that it shows you what you're doing. So you click on the advanced. And remember, we are going short. We are going short. So we now says open short. Open short, trigger price. What's your take profit price? We now go back to our sit down and say, see the trigger for the take profit is 1.5. That's what TP means. Take profit 1.548. We put it there. Okay. We now go back and check for our stop loss 1.746. 1.746. 1.54. 1.746. All right. So I had to go and take out the leverage and reduce it to the lowest, which is 1x for this particular calculation that we are doing. So I'll tell you guys how to use the leverage later. Maybe after this one, sir. After this one, so I'll show you guys how to use the leverage. So, but for the initial calculations we did, this there was no leverage in it. So you can see our take profit. If price reaches this region 1.548, you can see what is a when light species 1.5, market order will be triggered, and with an estimated profit of 600, we'll make $652 from this trade. It's telling you what we're going to make, which is 9.97%. Okay, as 1x. I don't like there's no leverage. Okay, there's no leverage. Then for the stop loss, you can see if price goes against us, if price goes against us, remember our position size was that's what we're risking was $200. All right, what we were risking from our account was $200. So if price goes against us and it goes back, if see when last price reaches 1.746, market order will be triggered with an estimated profit of. So now this is what we're going to lose basically of minus 116. So remember, we were saying we are going to lose $200, but because the market currently, that like I said, that was just a fictional, calculation and all that. So it was a signal that had already been it wasn't valid anymore. But you can see what I'm losing is not above the $200 that we even risk. So that is why stop loss is important. Do you understand? It's not above. So if I click on confirm, the order will be. Alright, so I click on confirm there. Everything is there. This is the target. This is that. You can see CP trigger price 1.5 oil, CP market, order price market. Alright, so this is for the stop loss. So now remember, it's a short. It is a short. It is a short. This is our margin. Alright, this is our margin. Well, from our calculations. Alright, this is our margin. Now see the estimated liquidation price. See the estimated liquidation price is showing that meaning our calculations was correct. Meaning our calculation was very correct. If the estimated liquidation price is higher for a short, you understand? If the estimated liquidation price is supposed to be for a short it's supposed to be higher than your what do you call it what's this word? Why am I missing this word now? I'll remember the word. All right, so your estimated liquidation price is supposed to be higher than your take profit price. Sorry, supposed to be higher than your stop loss. All right. Now, what was our stop loss? Our stop loss is where is it? SL. Your last SL is 1.746, and down here our estimated liquidation price. Sorry, let's come out. Our estimated liquidation price is 4.2730. So you will get liquidated when price reaches this region. All right. When price reaches this 4.270, that is when you get liquidated. But if before you get liquidated, you get to this region, you should have hit your stop loss. And that's why the stop loss is very important. So when it hits your stop loss at 1.746, you lose only that $100 that was showing that time. All right. So this is it basically. This is just how to calculate and understand it. So I'll give you a more way of calculating your position size. It's a more professional way. Okay, I'll show you another way now. I'll give you another formula. Okay, so that everyone can understand this basically. So, but I believe this one is understood. So now I see that and make sure that when you are making your trades, you check all these parameters. You check all this checking all these parameters is very important when you're doing your trade, making your trade. Checking all these parameters is very important. So our estimated liquidation price is 4.2. This is why this one is showing dash is because it's meant for on LBank. This is meant for if we were to go long, but the second one is meant for if we were to go short. But you can see our margin. What we calculated is our margin and all that. Okay, so this is how to use calculate your risk in a proper way so that you wouldn't lose. Okay, so that you wouldn't lose. You stay in the game. So what comes to whatever I'm going to lose from this trade is just $100 and something, which is normally it's $200, but because the calculation was wrong. But let me even see. Open short. Your order has triggered a limit. Please confirm to place order at the current minimum selling price. All right, so see everything that we did now. It has come out here. Open short. APC there. Make sure you're on perpetual futures. All right. See, see price. All right. Our entry price, our cost value, the type limit, our margin, estimated liquidation. Always come and check that the estimated liquidation price is for a short to make sure that your estimated liquidation price is higher than your stop loss. Always make sure of that. Then if you are going long, make sure that your estimated liquidation price is lower than your stop loss, and it should give it gap safe. It should give it serious gap. You can see the gap on gate 4.2 something something USDT, whereas our stop loss is 1.7 or thereabout. See our stop loss SL trigger 1.7. 1.7. So always check this. This window will always come out. This is the most final thing that you will now use to confirm. So I'll confirm this trade and see what happens by tomorrow. Maybe it can still go or not. All right. But whichever way, the stop loss will be triggered and I'll lose just 100. So whichever way, I'll show you guys what happened, the result of this by tomorrow. So this was just for a test run. Okay. So let me confirm. So I clicked on confirm. Request time that I'll try again. Okay, maybe I was there for too long. So let me do it again. Confirm, confirm. So order successfully placed. So it's ready now. Once you click once you place, it's already going in profit sale. All right. So because it was the trade was already that price limit has already passed. So it's going really down. See 7 points. So it's already reading, okay? So it's already calculating. So it's on positions now. You can see it. But when you're clicking on limit orders, it will come to orders usually. It should usually come to orders. You can see unrealized payment. I've already paid plus $25 already. You can see. See, I've already made some profits. I've already made some profit. So I could even decide to end the trade right now. I've already made $26 profit because the price is short and it's going down. Okay. I've already made some profit. I already entered. So that's just it basically. But this was just a test. Maybe I'll do a proper analysis and a proper trade for you guys, and I'll show you another professional um, formula that we use to calculate position size and manage our risks properly by tomorrow. Okay. For now, I think I'll just have to close this. Close this. Let me close this in profit. All right, because we already made some profit, but you can see close short confirm. So I made some profit. So once I do proper analysis tomorrow, I'll show you guys what to do. I'll show you how we can run this more on this. So I'm guessing if I'm exhausted. I would have showed you guys the other formula today, but I'm fully exhausted, and I'll do a proper breakdown more and explain this user interface better for you guys by tomorrow. You can see the money has come. I've added the little $19 I got, or 20 something dollars. Is I've added to my balance. My balance was 10,000 on it, but now I have $10,019. I made a little profit from that little trade. All right, and that's how it goes. That's how it works. That's how trading is. Trading is fun. It's fun and you make money, but if you only do the right thing, follow if you're disciplined. Everybody has to be disciplined. You need to be disciplined to make money in trades, in your trade. So it's a good way to always, it's a good side hustle. Let me just put it that way. So and I love LBank. LBank, the platform that gives us a 50% rebate. Please register with my LBank link. I'll post it in the comment section. I'll pin it up there. And so you can register with the link. And I'm guessing that we had fun in this session. That we had fun in this session. We had fun in this session. I love. Thank you guys for coming. So tomorrow we'll probably go deeper into how to calculate a better position size and a better using the leverage. We didn't use leverage today. We didn't use leverage today. So tomorrow I'll do an example using leverage properly. Using leverage properly to use position size and I will enter a full trade. And I'm promising you it's gonna be fun. We're gonna enjoy it. We're gonna enjoy it. We're gonna, I don't know. I'm not promising. I'm not saying, like I said, this is purely educational. Let me make that clear again. This is purely educational. This is purely educational. So, but you once you start getting used to it, once you start improving your skill in technical line, I'm also growing. So I'm also once you start improving your skill, you get better and better and better and better, and you will never regret it. Okay, you only regret it once you do the wrong thing. So today's topic was risk management. And what were the things that we said? All right, let me buttress that point. Your job as a trader is not to make money, but it's to survive, okay? Discipline is your reward. The market does not reward bravery, it rewards discipline. If you survive long enough, skill catches up. If you don't want, if you don't, nothing else matters. All right, that's just be disciplined. Be disciplined. Make trading rules. Make sure you always have a stop loss whenever you're entering. Make sure there's a stop loss. Don't be too confident, no matter who you are. Don't be too confident. Make sure there's a stop loss. All right. Enter a trade with stop losses. Do your analysis and always enter with stop losses. And don't risk more than 2% of your account. Don't risk more than 2%. Okay, let me just say 2 to 5% of your account. Me, I usually do 5%. I wouldn't lie. That's not just most I usually do 5%. So don't risk more than 2 to 5% of your account. So you still have many other opportunities to enter the account to go back into the market in case the trade goes sideways and doesn't go your way. All right. Today has been fun. I loved everything that happened today. And I think this is where we'll end. I'll see you guys tomorrow. We come back here same time tomorrow. All right. I'll see you guys tomorrow. Take care now. Love you guys.